welcome to Investment Matters with Peter Kinch, Diversify Alternative Investments today. And today I'm absolutely thrilled to have John Courtliff here with me from ICM. John is the Managing Director and Portfolio Manager for ICM. John, it's great to have you on our program today.
Yeah, thanks, Peter. Appreciate being here.
You know, a lot of people are familiar with REITs or mortgage investment corporations and whatnot. ICM is a little different, and not everybody's familiar. Maybe some people who are listening to this have not heard of ICM. I want to share some of the numbers because they're quite fascinating. First of all, ICM was originally founded by or started by Bruce Timms. It has an 18-year track record coupled with assets under management of over $1.2 billion. I'm sure that number is a little bit higher now, but that encompasses 12 different funds that have been launched since your inception. And you paid out over $183 million in distributions to over 5,000 clients over that time frame. So pretty impressive stats, pretty impressive numbers. What is Property Partners Trust? How is it different than the previous model? And what are some of the reasons you guys transitioned to that model?
Yeah, I mean, ultimately, it was a better fit for the investor profile that we're investing in our closed-end funds, and we believe that because ultimately, an investor's need for liquidity is going to vary greatly by investor, and ICM Property Partners Trust allows people to invest and redeem out to create liquidity for themselves at any given point in time thereafter, and what that means ultimately is that the gains that we realize on projects along the way are embedded in the underlying value of the units of the trust that investors hold. So when they redeem out, they eventually realize the gains that they've achieved. Obviously, there's a distribution paid in the meantime as well. Where historically what we employed were more closed-end funds, which, as you suggested, we raised a defined pool of capital, deployed it, and as soon as we liquidated assets within that portfolio, we would return that capital to the investors. So that model, put us more on a treadmill, if you will, where we're continually having to trade out of assets, return proceeds to investors, raise new capital before we're able to identify and invest in new opportunities. This open-ended structure that is Property Partners Trust is much more flexible in that context and allows us to better position investors over time for success.
There's three key components or strategies, if you will, to Property Partners Trust. One is income and growth, the other is development, and the other is high yield lending. I'd like you to speak to that in terms of how that works with each of those different categories, because again, it's not just one thing. You're not just buying apartment buildings or office buildings or lending on mortgages. You're doing three different strategies. So tell us a little bit about maybe the percentage breakdown on that within the fund, and some of the thought process behind why you went in that direction.
Well, I mean, really, we have the ability to invest along the capital stack in real estate and across different property types as well. And we believe that that's of benefit ultimately to investors because we've been doing this a long time, and retail investors, notoriously end up being the last invested in what are the next great opportunities by virtue of the structures that they have available to them through which they invest. And what Property Partners Trust seeks to do is to pool the capital of those investors and allow us the flexibility to identify where we feel the next great opportunities are in real estate. So we shifted a couple of years ago to industrial and industrial development, most specifically. And we'd spent a good year building a pipeline of opportunity before the pandemic hit. And that's allowed us to add a significant amount of industrial to the portfolio in the last 12 to 15 months, where previously it would have taken us, 12 to 15 months to make a first investment if we'd only shifted post-pandemic. And it's become, immensely clear to anybody following real estate that industrial has been where the opportunity has been, and it's become even more pronounced than it was when we first began focusing on the space. So, we feel that the Property Partners Trust structure is a valuable one for investors because it allows us to transition the portfolio over time and continually evolve where we're investing to try to capitalize on the best opportunities in market.
So again, getting back, if somebody asked me, okay, Peter, well, what should my expectations be if I were to take, again, I'll use the example of if an investor said, here's 50 grand, what would you say to that individual in terms of managing their expectations, in terms of what they should expect in terms of monthly or annual cash distributions versus growth, and what kind of timeline should an investor look at for this type of investment?
Yeah, so an investor can expect that their distributions will be 5 to 6% of their invested capital on an annual basis, and we expect to have some growth on top of that. So a total investor return of 8 to 9% is a reasonable total target, and that's achieved through not only the distributions but over time growth in the underlying value of the properties that the fund holds, and investors realize that that latter portion of return, 5 to 7 years after they've made their initial investment upon redeeming out of the fund.
When you're looking from today moving forward, what would you say are some of the biggest headwinds that you're afraid of, or things that keep you up at night, or risks that could potentially derail your best intentions?
Yeah, I think there's a number out there at any given point in time, and right now, I would say that we're in an ultra low interest rate environment, and asset pricing and in desirable asset classes reflects that, and that's true of not only property but the stock market more broadly, and really all other asset classes. And what that ultimately means is that cap rates are at very, very low levels, and future returns are going to be harder to come by in a rising interest rate environment, which hopefully we're entering into, which signals that that we're in a growth environment again. It is going to be more challenging to generate the same level of returns as historically have been available, simply because of the starting point, so to speak. But at the end of the day, we do believe that there's substantial growth coming, and in rents in particular, and that will offset some of the pressures that we anticipate experiencing over the next 18 to 24 months.
The other question, and wrap up with this, looking through the same lens, we talked about the risks. Where do you see the greatest opportunities, and what gets you excited about the upcoming years for ICM?
Yeah, where we see opportunity right now is as we've talked about, in both industrial as well as residential property types. We still believe that there's a meaningful amount of demand coming for those types of assets, and the ability to build into that coming demand is where we see a lot of opportunity. Where we don't see opportunity right now is buying existing in-place assets, simply because they're trading at values that are historic highs, and it's really, really difficult to justify an investment when cap rates are where they are. So we intend for the next 18, 24 months to be delivering new product to market, and then either crystallizing gains and through the disposition of assets, or refinancing properties and redeploying capital. And that's ultimately what you'll see from us.
John, thanks again. It's a pleasure having you on the show, and we look forward to talking to you again soon.
Thanks, Peter.